Hi, class. This is a review of Chapter 1, the 11 transactions that you need to know for the mastery and also for the test. This represents about 2/3 of the test points, being able to do these transactions and carry the balances. The 11 transactions are right here. To know your transactions, you need to be able to identify which classifications are impacted and how. And you do that by understanding which accounts under those classifications are impacted and how they're impacted, and then in turn how they impact the classification. So let's go ahead and get started. The first one we're going to do is receive cash as an investment from the owner. I'm going to go under the document camera. If we receive cash from the owner as an investment, that would make our cash go up. Let's just say it was $10,000. Okay. We don't owe money on the money we just invested into the business. So there is no liability for that. That 10,000 transfers to your value under capital as 10,000. So your owner's equity goes up 10,000 and your assets goes up 10,000 because of the cash in the capital. And over here, this is an investment in your capital account. All right. Turn down the brightness a little bit. Hopefully that helps. Okay. Next transaction would be paid cash for supplies. We are going to pay cash, which means cash will leave our business. So let's just say we bought $500 in supplies. So $500 in cash, bought $500 in supplies. So the cash goes down 500 and the supplies would go up 500. The money left the business, but the value didn't leave the business because it was replaced with actual supplies. So notice your capital account is not impacted. It does not go down. Cash goes down, supplies goes up. Okay, transaction 3, bought supplies on account. If we bought supplies on account, we know we bought supplies, so supplies is going to go up. Let's just say we bought, $250 in supplies. We bought it on account, which means we did not pay cash yet. We're going to pay cash later. That's what buying on account means. So we have a liability over here. And let's just say that it's this accounts payable ABC business that is the company we get our supplies from. So a plus 250 under liabilities to record that we owe them 250. Notice we're on the opposite sides of the equal sign, so these headers, these classifications have to move together. So this 250 makes supplies go up, makes assets go up. This 250 makes accounts payable go up, which makes liabilities go up. Next transaction, paid on account. Okay, well, let's just say we are paying on account for those supplies since we got something there. We're paying on account, which means we're paying off money that we owe. So we're going to pay cash. Let's say we are paying off $200 that we owe, not the full amount. So we are going to make our cash go down 200, which makes our assets go down 200. We are going to make our liabilities go down 200 also, because they don't owe us that money anymore. They just paid. Or I'm sorry, we don't owe them that money anymore, because we just paid them. All right, so we'd have a balance of $50 in there then after that. All right. This is one that we didn't really have in the class, but I thought I'd mix it up. We usually buy the insurance with cash, but let's just say we bought insurance, prepaid insurance. You can just shorten it as PPI. We bought it on account from the insurance company. We bought it on account. Okay, and we're just going to mail it to them later. So we bought insurance. Let's say we bought a year's worth of insurance, $100 a month. That's $1,200 worth of insurance. Plus $1,200 here. We bought insurance, and we bought it on account. And we bought it from, let's say, this XYZ company, accounts payable XYZ. So we owe them $1,200. We haven't paid them yet, but we will cut a check to them, and once we do that, we'd make our cash go down, and then we'd make our accounts payable go down. All right, cruising along. Hey, and this time we're just going to pay cash for insurance instead of buying insurance on account. Well, we bought insurance for cash, paid cash. Let's say we needed, I don't know, $500 more of insurance. So we're going to write a check for $500. Our cash goes down to $500. And we're buying insurance, which we're just going to add to our insurance. We bought $500 more of insurance. We have $1,700 in insurance now. So this is us getting insurance on account. This is us getting insurance for cash. Okay. Notice transactions on the same side of this line of the equal sign. The two accounts have to move in opposite directions to balance each other out, like these. Notice opposite sides of the equal sign. The headers, the classifications have to move together. And cash would make assets go up. That's a plus, and a plus over here, capital. Plus to capital would make owner's equity go up. So if the accounts are in classifications on opposite sides, they have to move together. If the accounts are in the same classification on the same side, they move in opposite directions. Okay. Receive cash from sales. All right, that's simple enough, hopefully. We received cash, meaning cash will go up. Let's say we did $2,000 worth of sales. That's a good thing. Our cash went up $2,000. Just like an investment, we don't owe money that has been given to us, for services that we have rendered. We don't owe money on that, just like we don't owe money on the $10,000 we put into our own business. So this $2,000 is straight owner's equity. There's no money owed on that $2,000. All right, let's see here. Got a few transactions left. Sold services on account. All right, here we go. The last transaction we sold, we received cash for services. So we received cash for performing a service. Now we perform services on account, which means we didn't get paid yet. So we perform services, which means we count the sale at the time of the sale. Let's pretend it was $1,000. This is for a sale for revenue. This was for a sale for revenue too. Only difference is this one, we got the money right away. For this one, we sold on account, which means we're going to get the money later. So we have accounts receivable, an account that we're going to receive money at a later date. They owe us $1,000. Let's call it DEF Company. Owes us $1,000. Now, when they pay us later, our cash will go up and our accounts receivable will go down. And the next transaction is just like we were talking about, receive cash on account. So let's go ahead and do that. Received cash. I highlight the whole thing. Come on. There we go. Receive cash on account. Okay. We received cash on account. Let's say they owed us $1,000 and they sent us the check for $1,000. Thank you very much. Received cash. Cash goes up. We received it on account, which means they don't owe us that money anymore, whatever they sent us. They sent us $1,000. We'll subtract it here. Now the updated balance would be $0. They owed us $1,000, so they paid off $1,000. Notice we didn't count the revenue over here because we counted it at the time of the sale when they bought it on account. If we threw $1,000 over here, it would make the whole entire thing not equal assets and liabilities plus owner's equity. And the transaction itself would be 2 plus 1,000 and only 1 minus 1,000. And that doesn't equal anything. All right. Paid cash for rent. Paid cash for telephone bill. Oops. Pretend this didn't happen. And paid cash to owner for personal use. Okay. We paid cash for rent. Let's pretend our rent was $1,500. Whoops. Not plus, a minus. You wrote a check for $1,500, paid cash for rent. So over here under capital, we're going to make our capital, our value in the business, go down by $1,500 because of that expense. This is an expense account. Money leaving your business for operations of the business. Sales, revenue, money entering your business for the operations of the business. Okay, we paid cash for rent expense. Rent. We're now going to pay cash for, oh boy, where is it? Where's the other one? Pay cash for telephone bill. Okay, well, we paid $500 for a telephone bill. That's a big telephone bill. Pay cash for telephone bill. That's a utility. You'd have a utilities account, utilities expense account. There we go. And the very last thing that we needed to do, transaction 12, was we took money out of the business for personal use. So money will leave the business for personal use. It isn't an expense, but it impacts the equation the same way. Let's say the owner took $1,000 out so he could pay his personal bills. It's kind of his money, even though it's the business's money. He earned it. He owns the business. So $1,000 comes out of cash. You come over here, you need to subtract $1,000 from capital because the value has left the business. You can replace it with supplies or with insurance or anything like that. The key here, and you'll see it on the test, this isn't an expense, this is a withdrawal. Impacts the equation the same way, making owner's equity go down, making capital go down, and owner's equity go down, but it isn't an expense. Okay, expenses for operating the business, withdrawals for personal use. I hope that helped you. That was just to go over these transactions. Have a great day.